It's Wednesday. It's about 11:45, and like everybody else, we've been looking at IBM and some of the other stocks and indexes, and wondering if indeed this is a bear market rally or a new bull market. But we can see that IBM is pushing against the top of an expanding range, and by many of the indicators is overbought. This is the accumulation distribution chart, and we can see that IBM has been under accumulation since November, so it's really no fluke. We can also notice that the MFI, the money flow index, has reached an oversold or extreme condition from which a downturn of some size could be anticipated, as has happened in the past. But IBM is under accumulation. I think that's the important message to gather from there. But instead of looking at oscillators and indicators and trying to figure out whether something's overbought or oversold or too overbought or too oversold or whatever, let's look behind the bars or behind the chart and try and capture the story. What's going on between the buyers and the sellers, the bulls and the bears? And to do that, well, we're going to look at our Wyckoff Tape Reader chart, which presents the bar information in a pretty much entirely different way. And we'll enter IBM, hit go and pull up the IBM chart. We'll size it out and do a little housekeeping with the numbers. But this is the February 11th low. And what these numbers represent is on balance volume for each individual bar. Just like there's on balance volume for the market as a whole, you can do on balance volume for each bar by sampling the buying and the selling that's going on internally on each bar, and that's what we've done. The black numbers represent a positive on balance volume, and the red numbers are a negative on balance volume. And usually you can kind of guess what's happening with the bar, but it's not always the case. Sometimes it's surprising that an up bar can be a distribution bar or a down bar can be an accumulation bar, but that does happen, and I think that when you see it firsthand, I think it adds some knowledge that you otherwise would not be able to get. But from the February 11th low, we had three gap up bars followed by an even bigger gap up bar. And at that time, although we couldn't see ahead, we could have anticipated once the next one or two bars came in that there was going to be a pause here and perhaps a consolidation or trading range develop, so we could put in a horizontal line to mark the potential bottom of the range. And then we just followed the bars over the next week or so, and we could see that there were both accumulation bars with the black numbers and distribution bars with the red numbers. But none of the distribution bars, or even a combination of distribution bars, was able to take out the bottom of the range to any significant degree. And that indicated that the buyers were able to absorb all of the selling and not allow the sellers to gain control and take the market down. So just based on that alone, we saw at least the potential for another push up. And that's indeed what happened. Even though on balance, on total, there was probably more distribution in those bars than there was accumulation, but not enough to take down the price. Following the consolidation range, which lasted, 5 or 7 days, there was another push up. And we can see that most of those bars were accumulation bars that went higher, with one distribution bar which happened on yesterday. But again, the buyers are able to absorb that selling and it was not able to make a new low, and that resulted in today's up bar, which is also an accumulation bar. So at this point in time, at least, the buyers are still in control, and we would probably have to see today's bar close below the open to change that story. Of course, what happens tomorrow is anybody's guess, but based on this, it's not likely that we're going to see a downturn without a much lower close than where it is. Wyckoff suggested drawing trend lines on your chart that you could use as well, resistance and support, if you want to call it that, or as supply and demand lines. And one of the prime concepts that Wyckoff taught was something called the shortening of the thrust. And you can see that by the converging trend lines. We call it a wedge. Wyckoff didn't call it anything other than shortening of the thrust. But that often happens prior to a change in direction. Of course, we still have to wait for the proof of that to happen. It hasn't happened yet because we can see that all of the selling has been absorbed by the buyers who are still able to push prices higher. But I think the next couple of days could be interesting because the thrust has certainly been shortened. And it may be time for the bears to start pushing back. But in any event, I think we got a little look inside the bars. It made the whole story a little more interesting. And we can see that there's a real contest between real people. Well, we'll just have to wait and see what happens tomorrow.